What if I told you there's a crypto project that lets you literally trade tomorrow's money today? In the past year, Pendle Finance has grown from 250 million to over 8 billion in total value locked. But here's the kicker. Most people still don't understand what it actually does. I'm Shay, and I've spent 3 years digging into crypto projects and made 100+ review videos. Here at Deciphering Crypto, we make crypto, blockchain, and AI simple for everyone. Today, we're investigating Pendle Finance, the good, the bad, and what you should know before you do anything. Many tokens in the crypto ecosystem produce yield, or interest payments from staking or holding the tokens. This includes staked Ethereum or staked Athena. Pendle V2 app is a marketplace that slices yield-bearing assets into two tradable pieces, and I think of it as the tree and the fruit. The tree is the principal or the underlying asset, and the fruit is the future yield. Pendle also has a new module called Boros. It does a similar trick for perpetuals funding rates, turning those up and down fees into something you can buy, sell, or hedge. The two headaches are, first, yields on assets like staked ETH swing a lot, and two, funding rates on perp exchanges swing also. Pendle lets you lock in or bet on those future numbers instead of just hoping. Pendle is one of the largest yield tokenization platforms in DeFi by total value locked and fees. Boros is new but expanding markets quickly. Links to live dashboards are in the description. Pendle exists because people want to lock in fixed yield, speculate on future yield, or hedge it without giving up the underlying asset. As of today, Pendle's total value locked is around 13 billion across chains, with multi-billion monthly DEX volume, putting it among the largest yield platforms in crypto. By the end, you'll know if Pendle V2 and now Boros solve real risk and hedging problems, or just repackaged complexity. With that context, let's zoom in on the real-world problems Pendle is trying to solve. There is the variable yield problem. Crypto yields pop and drop. Savers, DAOs, funds want to fix or hedge what they'll earn. There's the funding rate problem. Perp traders pay or receive a fee every few hours that swings like crazy. That makes P&L bumpy and hard to plan for. If you're wondering what a funding rate is, simply a funding rate is a periodic payment between traders in a perpetual futures market that helps keep the contract price close to the real or the spot price. If the rate is positive, longs pay short. If it's negative, shorts pay longs. So it can change your P&L even when the price doesn't move. On-chain markets let anyone tokenize these future cash flows, settle transparently, and compose strategy in one place. Boros turns funding rates into tradable yield units so traders can hedge, speculate, or stabilize returns without constantly micromanaging perps. Then you also have to consider the context of market sizes. What are the size of these pools? The TradFi interest rate derivatives market is $500+ trillion globally. There is the DeFi yield market, which is growing but fragmented across protocols. The daily perpetual trading volume is 200+ billion, and this is where Pendle's new Boros product competes. What does the competitive landscape look like? Other yield tokenization or rate products do exist, but Pendle's liquidity, cross-chain footprint, and now Boros give it a broader interest rate marketplace position rather than a single feature app. Now that we know what the problem is, let's break this down like you're 10 years old, or as my coworker says, like you're a 10-year-old savant who graduated from Harvard at 9. This stuff can be complicated, so I'll do my best. Step 1, asset tokenization. Pendle takes a yield-bearing asset like staked ETH, splits it into two tokens. You have PT, or the principal token, your original ETH that you get back later, and then there's YT, which is the yield token, all the future staking rewards. This step 2 is just the magic of separation. This is like separating the apple tree from its apples. You can sell the apples while keeping the tree. And then step 3 is trading market. Both the principal token and the yield token can be traded on Pendle's special AMM, or that's an automated market maker. Let's say Sarah has $10,000 in staked ETH earning 5% APY. Deposit staked ETH into Pendle and gets PT staked ETH and YT staked ETH tokens. Now she has 3 options. She can sell the YT tokens and get cash now from future yields, or she can buy more YT tokens. This is a bet on higher yields in the future. Or she can hold the PT tokens, which is the principal token, guaranteed to get her original ETH back. Now the marketing says revolution revolutionary yield management. Reality, it's sophisticated but adds complexity. You're essentially creating a derivatives market for DeFi yields. It's very powerful, but it's not simple. So what's genuinely the new tech with Pendle? The V2 app is the first protocol to cleanly separate yield from principal in DeFi. Boros is the first to tokenize perpetual funding rates as tradable instruments. And then there is the custom AMMs, or the automated market makers designed for time-decaying assets, like in V2, and volatile derivatives, like in Boros. There is also eliminated impermanent loss through innovative curve design. The app is clean, but concepts are new. Pendle does have an academy and docs that use simple analogies that help first-timers. With the mechanics in mind, let's take a look at the utility and tokenomics of Pendle, what it does, and how value flows. As far as utility, what is holding Pendle actually good for? Not much if you're just holding it, but you can lock them into VE Pendle to vote where incentives go, boost LP rewards, and then you also participate in revenue sharing, which is awesome. I love revenue sharing. The revenue model for Pendle is 5% fee on all yield generated, 80% of trading fees, and 80% of that revenue goes to VE Pendle holders. Now, these protocol terms are current and they could change via governance in the future. So that is the utility. Let's look at supply and emissions. The total supply of Pendle token is not a hard cap. Currently, there's 170 million tokens that are circulating. All of the team and investor tokens have been fully vested as of September of 2024. About 218,000 tokens are released every week. Weekly emissions decrease by 1.1% until April of 2026, then switch to just a flat 2% annual termination inflation for long-term incentives. It's great that the token is good for this stuff, but does it have to exist for all of this to work? And the good news is, for Pendle, yes, it's needed for governance, incentive routing, and fee distribution. Without a token, coordinating incentives and directing liquidity would be much harder. If you want to buy Pendle, it trades on all or most major exchanges like Binance and Coinbase with active volumes. Next, who's behind and how credible is the project? Pendle is being led by T.N. Lee, who's the founder and CEO, previously founded Dana Labs and then pivoted to Pendle, and also co-founder and CTO VU Win, who was previously the CTO of Digix. Pendle's contracts are open source and have multiple audits from Least Authority, DDoB, Chain Security, Aki Blockchain, Dingbats. No audit guarantees safety, but multi-party reviews are definitely a plus. The transparency and updates are good. Docs are thorough, see links below, and app dashboards show current VE Pendle stats, revenue to lockers including monthly revenue figures. Pendle investment has included a $3.7 million seed round back in 2021, and notable investors were Binance Labs, Hashkey Capital, Mechanism Capital, and the Spartan Group. Back in August of 2023, there was additional funding from Binance Labs. They have deployed across major EVM chains like Ethereum, Arbitrum, BNB, Base, Optimism, Mantle, expanding surface area, and users. As always, we need to weigh the risks before drawing any conclusions. Technical risks include smart contract risk, and it is real. Even adjacent projects can be attacked. In 2024, PenPy, a yield farming protocol built on top of Pendle, was exploited for $27 million. Pendle said it helped prevent a larger loss, and its core protocol remained unaffected. Still, composability risk matters. There are market risks. If yields fall, YT underperforms. If underlying assets depeg, your principal tokens can trade below expectations. Liquidity can thin in niche markets, creating wider slippage. And right now, most projects face regulatory risks. Products tied to yield and points could attract regulator attention in some regions. Pendle treats points as yield and takes fees on them. Policies may evolve. There are also operational dependencies. Pendle leans on upstream protocols such as lending markets, restaking, and reliable oracles for pricing. Failures upstream can propagate. With risks on the table, let's look ahead at where this could go. What does the future and roadmap look like? Expansion right now have three main pillars. First, enhanced V2 yield products. Second, multi-chain expansion, which is ambitious but logical expansion. Success depends on L2 adoption rates. Third is the recent Boros launch, and it's the perpetual funding rates. With initial success, it addresses 150 billion plus perpetual market. The total addressable market has much larger potential. If fixed or floating on-chain yield and funding rate hedging keep growing, Pendle's addressable market could expand beyond liquid staking token yields and toward derivative scale activity. Execution and risk controls must keep pace. So how does that translate into an investment thesis? And what else should you compare it to? Arguments for investment include clear product market fit for yield tokenization with real total value locked and fees, value accrual to VE Pendle via yield token fees and voted swap fees. Then there's also the expanding scope with the Boros app. Key concerns against investment are smart contract or composability risks, complex user interface for beginners, concept risk if yields compress, and then emissions continue for the token. So it's not a hard cap. Alternatives to Pendle are pretty slim, but there is Spectra and Napier for smaller yield tokenization plays, or traditional fixed income off-chain alternatives for simpler regulated exposure. Your due diligence checklist for this project would be audits, and then total value lock trend, and then fee and revenue trend, pool depths and slippage. Chain exposure, upstream risk would be restaking trends and governance updates. With pros and cons weighed, here's my balanced verdict. Execution gets an A- for shipping V2 on time, point support, and Boros launching well. Technology gets an A-. There's a clean PT, YT design, multi-audit posture. There's still a crypto risk. Market positioning gets an A, definitely the category leader by total value locked. Trust and transparency gets a B+. Open docs, dashboards, but there was the third-party incident last year. Competitive advantage is an A-. Network effects and liquidity plus integrations. Tokenomics gets a B, reasonable but reliant on protocol success due to no hard cap. Overall grade is a B+. Good solid project and team with above average potential in my opinion. I really like the comments you guys have left me. I'd love to hear some more. If you could lock in a fixed crypto yield, would you? Why or why not? Which risks here worries you the most? Smart contract, market, or liquidity? How would you judge good tokenomics? Subscribe for follow-ups on Pendle and other projects we've looked at. Like this if the breakdown has helped. Share with a friend researching DeFi yield. This video is definitely educational only. It's not financial advice. Crypto is risky. You can lose money. No sponsorship influenced this review. I do not currently hold any Pendle. All sources are linked so you can verify independently. Thank you for watching and check out some of my other content. I'll see you next week. Take care.